Welcome to Trading Nation. I'm Seema Modi. The S&P 500 kicking off the second quarter on a strong note, breaking above 4,000 for the first time ever. Tech stocks leading the charge through the psychological milestone, but on the path to 5,000, could other winners take over? Let's bring in Bill Baruch of Blue Line Capital and John Petrides of Tocqueville Asset Management for their highest conviction trades. Moving forward as we kick off the second quarter, Bill, it was value that led the charge in the first quarter. Does it turn back to technology?
I think value is going to continue to lead, and I have a 12-month rolling target in the S&P of 4,600. Yeah, that's 15% away from here. It's very achievable before the end of this year, but again, it's a 12-month rolling target. Some of my highest convictions still industrials, with energies, materials, and banks kind of right behind that. Overall, I think economic activity is going to continue to pick up. I think as well, the infrastructure spending is going to be a tailwind, and deal activity in general is going to be a tailwind to the sectors, especially banks. So overall, I do think that the path of least resistance is going to be higher. In April, I have very high expectations for. Some of the names, or some of the spaces that I like the most have been rails. Overall, rails and aerospace and aviation has been a really good area, and I think that continues to thrive. In fact, Kansas City Southern is one of our largest holdings, and look at that deal activity that's already taking place there. I think we're going to continue to see the tailwinds again with that economic activity. Raytheon is another one that we own that we like a lot. And then in the energy space, I do think crude oil is going to be back above $70. I think really $100 could be in the cards to the first half of next year. You're seeing OPEC Plus today, put out another good deal, and they're slowly, gradually bringing back production. Crude oil has been consolidating at $60 through this last couple of weeks, and that could overall getting OPEC Plus in the rearview mirror should bring a tailwind to the market. I think crude more sooner than later could start moving it back towards $70. Chevron's a name that we love. We also own Pioneer and Marathon Petroleum, and then good exposure in the midstream space. Overall, though, you can't ignore tech, and that's one of the important things, especially if you're actively managing these markets. There's really great rotations going on, and you don't have to, really be on top of it, forcing trades. It's just being patient with what you're seeing. When tech has had these really big runs, sort of trimming names like Apple and Microsoft, PayPal, that has proven to be a really good strategy. And then rebuilding those positions on extreme weakness that we've seen here through the month of March. I think tech, right now, you can't ignore the fact that the NASDAQ is breaking out above a trend line going back to February 16th.
Right.
And it's coming through the 50-day moving average right now. So going to be moving higher there. I like tech as well.
Let's go to John here, where it's hard to dismiss the fact that we are seeing such a strong move in technology on the first day of the second quarter. A name like Alphabet, John, Facebook, Amazon, Apple, all those companies that underperformed in the first quarter now seeing gains here of 2 to 3%. How should we read that?
Yeah, well, I mean, Bill covered just about everything.
He did.
I'm going to take a slightly different approach and make it a bit more simplistic, and focus on fundamentals. Forget value for a second, forget growth for a second. And a strong thesis that was coming into pre-COVID was robotics and artificial intelligence. And we're sticking with fundamentals. And we think the BOTZ, B-O-T-Z, the Global X Robotics and Artificial Intelligence ETF is a great way to play a very strong long-term fundamental story here. So you don't have to worry about where interest rates are going to be per se, or the value versus growth trade. The BOTZ ETF, the top 10 holdings, has a nice smattering of industrials and tech, so you're not necessarily concentrated in one specific sector. And we think in a post-COVID world where the supply chain is going to have to get more efficient, where you're going to have less human contact within the supply chain, that favors the robotics side of the coin. And obviously, companies are doing more with less and are forced to do more with less, which is going to favor the artificial intelligence side of the coin. And we think those two themes have a very long runway to go ahead. So we think this is a good diversified way to play what Bill alluded to, which is everything's kind of going up.
I do sense this level of optimism from both of you, and I on the first day of the second quarter. But if there was one risk that you think investors should be mindful of, John, whether I just did a story last night for the Shep Show about how plastic prices are on the rise, inflation, the global supply chain constraints. To you, the biggest risk is what?
Yeah, I think in the really short term, in the upcoming quarters, it's unforeseen margin pressure. And you hit on a lot of those issues. So companies have been talking about supply chain issues that are hitting margins. We have the epic rise in commodity costs over a really short period of time. We had the power outages in Texas, where a lot of chemicals come out of Texas that could lead to higher costs. We're having rising inflationary costs as well. So, and who knows how, rising gasoline prices and this blockage in the Suez Canal that we saw over a couple of days could all lead to rising short-term pressure on companies' margins, which the street may not be entirely ready for in the upcoming quarter. But I do think, to steal a word from the Federal Reserve, those are all transitory, because I do think that as long as the economy continues to open up here in a post-COVID world, and all the stimulus that's coming too is going to drive top-line demand stronger. So the one risk in the short term to company upcoming earnings will be the headline numbers could be slightly weaker because there could be unforeseen margin pressure.
Bill, just quickly, biggest risk?
I think pockets of illiquidity in the Treasury market. And that's one of the reasons why we're rallying right here today, is because the infrastructure spending bill deflected more debt printing. Instead, it's going to focus on tax hikes. But, tax hikes could be a headwind too. But overall, it's the Treasury market liquidity. Look at those 7-year note auctions have just been awful. And you get those big days down in the Treasuries. It's going to weigh on tech, and that's going to drag the broader market down lower on some of those days. That's why I think a very good diversified portfolio with strong technicals, strong balance sheets is a way to be playing the market.